and welcome to the Financial Planning Association's annual conference in Nashville, Tennessee. I'm Emily Smykel with Investopedia's Advisor Insights, and I'm speaking with Dan Moisand today. Dan, thanks for joining us.
Sure, my pleasure.
Why don't you tell us a little bit about yourself?
Okay, I live in Melbourne, Florida, which is on the East Coast by the Space Center.
Yeah.
So our area code is 321 accordingly. So we run about a $500 million RIA out of Orlando with an office in Melbourne. And most of our clients are just normal folks with $1 million or so dollars, not a whole lot of super ultra wealthy.
Okay. So today we're going to talk about the active versus passive management debate that has been going on for quite some time in the investment world.
Right.
How do you explain that debate to your clients?
Yeah, most clients are completely unaware of the debate. The way we explain it is it's a simple mathematical issue on one level, which is everybody owns everything. And so passive investors just buy and they hold whatever portion of the market that they're in. The active investors are trying to do a little bit better than the market by either getting in and out or just buying the best securities or avoiding the worst or whatever. And when they do that, they have to incur costs that the passive investors do not. So mathematically speaking, the passive investor is going to do better than the average investor that's being more active. There's definitely going to be people that outperform the market, but we know that over time, fewer and fewer people beat the market by generally less and less.
So I imagine with your clients, you first try to understand what kind of risk they're willing to take and how active they may or may not want to be, just to see if it's even appropriate for them.
Yes, I mean, most people that come to us specifically because they really don't want to mess with the investments themselves.
Yeah.
They're trying to delegate that responsibility. They're relying on us to figure out what's best for them.
Right.
But there are a lot of people out there that are pretty active with their money. Some of them don't know that there's another way to do it.
Right.
And some of them just like the action, so to speak. So there's a place for both ends of that spectrum.
Right. Do you prefer one over the other?
I personally and all of my clients, to the extent that they will let me, are passive across the board as far as the choice of investment vehicle. Okay. And there's a lot of reasons for that.
Yeah.
One of them is from a planning perspective. You spend a lot of time trying to understand the risk-return trade-off of a given portfolio structure. Right? So if you're using passive vehicles that are good ones, properly constructed, and own what they're supposed to own, you know you own that all the time. You don't have to worry about a manager having a high cash holding or deciding to take an outsized position here or there. So you really have much more control over what your clients own. The cost is obviously attractive. It's typically very low if it's done right. And tax efficiency is usually much better as well. So those are pretty compelling reasons to be as passive as possible.
Lately we've really seen a lot of inflows into passive funds, into index funds, and active management at least seems to be out of favor with a lot of investors. Do you see it sticking that way? Do you think the trend will continue?
Yeah, I think for the time being that it will. I think as the costs of the active managers get lower, the disadvantage that they have shrinks as well.
Right.
So I think that lowering cost trend is really the dominant factor there. Most people, though, there's something about trying to beat the market that's just, it's too much temptation to avoid. So there's always going to be a significant place for active management.